There has been some confusion in understanding the asset valuation reports generated by the Asset Valuation module of MDW. We hope we can clear up that confusion with this video. I have prepared a typical report for road assets. This report is a 2009 annual report using the current month option to amortize additions, betterments, write-downs, and disposals. The columns initial value, accumulated additions, accumulated deductions, and accumulated depreciation are values brought forward from the previous reports. The columns beginning value, additions, disposals, write-downs, write-ups, and ending value are values generated in the current reporting period. The cost of an asset can be calculated by adding the initial cost plus any accumulated additions minus accumulated deductions, which then equals the asset cost or gross book value. Let's define the columns in this report. Initial value is the cost paid to purchase or build an asset. In the first report, you do have an option to use discounted replacement cost to calculate a theoretical initial cost. All subsequent reports require you to add a lifecycle event that includes the cost to build or acquire an asset or any cost incurred for any change in the value of your assets. Accumulated additions is the total cost of all previous betterments to an asset. Accumulated deductions is the total cost of all previous write-downs to an asset. Accumulated depreciation is the total amount that the asset has depreciated in value since the asset was purchased, constructed, reconstructed, or installed. For this report, the beginning value represents the value of the asset as of January 1, 2009. This value is brought forward from the previous report and is the ending value in the previous report. The columns additions, disposals, write-downs, write-ups are all tied to lifecycle events. Lifecycle events can be created for each asset record in MDW. Click on the asset ID to access the asset record. Click on the lifecycle event to reveal the content of the event. When the work is completed on an asset, the total cost of the work must be included as a lifecycle event detail. That work is transferred to the report as an addition, as this work is identified as a rehabilitation. Lifecycle events denoted as construction reset the clock and consider the event as a new asset. Likewise, write-downs, write-ups, and disposals are lifecycle events, and the total cost of the event is transferred to the report. The asset valuation module is date sensitive. If you are creating a report using current month valuation and you want to amortize half the year's value in the first year, you must enter July 1 as the date, regardless of when the actual work was completed. The same applies to write-downs or disposals. Let's go back to defining the columns. The additions column contains the total cost of all asset betterments and new assets built or purchased within the reporting period that are capital additions greater than the capitalization threshold. If you're not sure whether the addition value is a betterment or a new asset, you can check the asset record by clicking the asset ID number, or here's a tip. If the asset's beginning value is 0, the asset is probably added to the inventory during the reporting period. To avoid overstating the value of your assets, add the total initial value of the asset type plus the total accumulated additions plus current reporting year betterments. Do not include the new assets purchased or built in the reporting period, as those amounts are already included in the total initial value column. Otherwise, you would be overstating the value of your assets. Disposal is the total value received by the municipality or applied by the municipality upon disposal of the asset. For example, a disposal amount may be a trade-in value of a vehicle or the value of aggregates in the road base that may be recycled or reused. The write-downs column can include either a write-down or a write-off. A write-down is used to reflect a partial impairment in the value of an asset. A write-off is used to reflect total impairment in the value of an asset. Capital assets are written off in instances where they are destroyed, lost, stolen, sold, or obsolete. Write-up is a non-betterment increase in the value of an asset. A non-betterment write-up might result from an appraiser providing an opinion as to the value of a building. If you choose, you could write up the value based on the advice received. Depreciation applied is the accumulated amortization for the reporting period. And finally, ending value is the net asset value at the end of the reporting period, otherwise known as net book value. When the next report is prepared, the values for betterments, write-ups, and write-downs in the current report are moved to the accumulated additions or deductions column in the subsequent report, as the case may be.